Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Tuesday, everybody. From today, China goes on vacation for a week for its National Day holiday celebrations. Today represents the 75-year anniversary of the founding of the People's Republic of China. While the country takes this week off, I will continue to produce China Update episodes as usual. First up, let's once again discuss the massive Chinese market rally over the last week. Indeed, today's episode will be primarily looking at this, as well as the wider economic conditions and the stimulus announcements which have fueled this market rally. We actually covered some of this on Saturday, but it's worth supplementing the stock market side of things and that discussion here. Chinese equities posted their best day since 2008 on Monday, extending a historic rally triggered by Beijing's bumper stimulus package. The Shanghai Composite Index increased by 8.06%, and the Shenzhen Component Index ended 10.67 percentage points higher. Chi Next Index, tracking China's Nasdaq-style Board of Growth Enterprises, witnessed an increase of 15.36%. The index that comprises 50 representative companies listed on the Beijing Stock Exchange increased by 22.84%. On Monday, the turnover from the Shanghai and Shenzhen stock exchanges exceeded 1 trillion yuan for the 4th consecutive trading day. At one point on Monday, some $143 billion worth of stocks changed hands in 35 minutes of fevered trading in Shanghai, Shenzhen, and Beijing, the shortest ever span of time in which stock trading hit the 1 trillion yuan mark in the country's history. China's benchmark CSI 300 index has soared 25% since the country's central bank unleashed the first wave of easing measures on Tuesday last week, erasing the previous nearly 14 months' losses in the span of 5 trading sessions. By the end of the day, Monday, the value of stocks traded in China's domestic stock market had reached $372 billion, the highest single-day total ever. The rally marks a stark turnaround for the Chinese market, which has suffered big falls over the past 3.5 years as foreign investors flee in the face of concerns about a slowing economy and a slow-burning crisis in real estate. In a report on Monday, Thomas Gatley, China's strategist at Gavikel Dragonomics, provided great context for this latest rally. We are looking at their chart here. Of the 5 major stock market rallies in China in the past quarter century, 3 were powered by stimulus. Stocks during those episodes notched trough to peak gains of between 50 and 100%, suggesting that this rally could have much further to run if policymakers follow through with meaningful stimulus and property market support. Indeed, as Peking University professor of finance Michael Pettis observed today, quote, "A well-functioning and stable market is one driven by a wide variety of uncorrelated investment and speculative strategies, so that information is interpreted differently by different investors. In this case, there's only been one strategy: front-run government support for the market. The problem is that when everyone is looking at the same information and interpreting it the same way, the market tends to go either straight up or straight down. We saw how this works in 2015 through 16. The market surged 150% once it became clear that Beijing would do whatever it takes to boost the market, but when the market sentiment turned, it turned astonishingly quickly." End quote. Now let's end part 1 with this observation by veteran China analyst Bill Bishop. Quote, "It feels a bit like 2014, when the market more than doubled in 8 months before crashing. I understand why there is skepticism about the current explosive rally, and reminders that Japan had several big bear market rallies over the decades. But good luck to investors who try to short this surge anytime soon. The Finance Ministry and People's Bank of China printing presses, plus people who have not been able to make money since COVID suddenly finding animal spirits turned back on, are hard to fight. Hong Kong markets will reopen later this week. The mainland markets are closed until October 8th. End quote. Next up, let's look at the property market specifically, as well as the measures that have also been announced over the last few days, which has fueled this rally on the Monday. And then we have to also look critically at whether this market rally is a sign of good things to come, or whether it is divorced from the economic reality on the ground. But just quickly first, if you're enjoying today's episode of China Update, don't forget to hit the like button. Liking, sharing, and subscribing is a tremendous help. About 41% of regular viewers are not subscribed. It'd be great if we could get this under 40%. So if you do like these episodes, maybe consider subscribing, hit the bell notification, and you'll be on top of these updates as they are released. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. Okay, now let's move to part 2. Over the weekend, we saw more signals from Beijing that measures to stabilize the real estate market are coming. Indeed, the latest leap in stocks from yesterday came after 3 of China's largest cities relaxed rules for home buyers, while the central bank also moved to lower mortgage rates. On Sunday, the People's Bank of China and the National Financial Regulatory Administration rolled out a wave of policies to stabilize the real estate market. The mortgage rates for first homes, second homes, and more are required to be reduced no lower than 30 basis points below the loan prime rate by the 31st of October to ease financial burdens on property owners. The minimum down payment ratio for individuals' commercial housing mortgages will be lowered to no less than 15% for both first home and second home purchases. The same day, Sunday, Shanghai, Shenzhen, and Guangzhou all announced adjustments to their respective rules on home buying qualifications, with Guangzhou scrapping all curbs on home buying in the entire city, regardless of the buyer's marital status or whether the buyer holds a local household registration, known in Chinese as hukou. Beijing is also cutting minimum down payment ratios for first homes to 15% and to 20% for second homes. Chinese financial media outlet Yicai writes today that although there are different elements behind the slump in home sales in different cities, people have overall determined that they would avoid buying homes so as to take on less debt. Quote, "The new measures announced by these 3 cities can hardly turn that sentiment around. It will also take time for the new measures to be implemented." End quote. These measures, combined with the Politburo's statement last week, have caused Chinese property shares to do especially well in this most recent rally. A Bloomberg gauge of Chinese property stocks jumped as much as 14% on Monday morning. Now, before these new stimulus measures were announced, China's home sales slump intensified in September. Indeed, it could well have been this poor data that in part pushed the Politburo to make its unusual statement of support. According to preliminary data from China Real Estate Information Corp, the value of new home sales from the 100 biggest real estate companies fell about 37.7% from a year earlier, much faster than the 26.8% decline in August. Chen Wenjing, research director at China Index Holdings, expressed on the numbers, quote, "Home buyers have stayed on the sidelines in September, watching for property stimulus. Home buying activity may pick up a bit in October after stepped-up support. However, more loosening is needed for the housing market nationwide to stop declining." End quote. The weak data underscore why China's Politburo last week made its most determined pledge yet to stabilize the real estate sector. Morgan Stanley analysts wrote in a Sunday note, quote, "Regulators are aiming to stabilize rather than rejuvenate the housing market, albeit the overall tone was more than market expected." End quote. Meanwhile, at the weekly State Council executive meeting, Premier Li Qiang called on officials to, quote, "focus on solving prominent problems in economic operation and to strive to complete the annual economic and social development goals and tasks. For each policy, clear responsibilities must be assigned. The pace of introduction and implementation must be accelerated. Policies that are relatively mature should be launched immediately, and policies that need further refinement should be worked on urgently and launched in batches as they mature." End quote. He also called on the government to strengthen coordination through, quote, "effective macroeconomic control," end quote, and develop, quote, "new incremental policies," end quote, in response to evolving circumstances. Li's comments serve as an additional incentive for China's vast state apparatus to mobilize and meet the annual gross domestic product growth rate of around 5%, a task made harder by weak domestic demand, distress in the property sector, and strains on local government coffers. all themes we have followed very closely. Now, finally for today, let's bring these themes which we have covered in the episode together. I wanted to end with a long commentary published today by several authors from Chinese financial media outlet Caixin called "China's Stimulus Bomb Sparks Optimism, but Economy May Still Struggle." This is important to remember as we see headlines of Chinese equity rallies from the last few days. We now quote selected excerpts from the long piece directly. What a difference a week can make. As millions across China prepared to head off for the vacation in the days leading up to the National Day break, the announcement of a slew of aggressive stimulus measures and an unusual Politburo meeting addressing economic challenges propelled the benchmark CSI 300 index to its biggest weekly gain in nearly 16 years. Such was the optimism. The announcements also prompted major foreign banks, including Goldman Sachs and JP Morgan, to raise their GDP growth forecasts for the nation's struggling economy. Despite the initial positivity, some analysts question the long-term impact of the measures and whether they will go far enough. However, while the jury may still be out on their effectiveness, the policy announcements themselves and the manner in which they were deliberately underscored the gravity of the situation facing the nation's top leadership. This was evidenced in the Thursday meeting of the Politburo, led by Chairman Xi Jinping, as it took the unusual step of tabling macroeconomic matters ahead of schedule, suggesting a heightened urgency to stabilize the economy. Macroeconomic discussions at the monthly Politburo sessions are typically scheduled for April, July, and December. Moving the topic up to September emphasized the leadership's concern and commitment to reviving growth. The immediate market response to these announcements was striking. The CSI 300 index, which tracks the top 300 stocks on the Shanghai and Shenzhen exchanges, began its surge on Tuesday, eventually rising over 15% for the week, the biggest since 2008, while the Chinese yuan strengthened to a 16-month high against the dollar. Economists at Morgan Stanley, Citigroup and JP Morgan have increased their estimates of GDP growth, with some now forecasting growth as high as 5.4%. However, Morgan Stanley's chief China economist, Xing Ziqiang, cautioned that while policymakers are seriously addressing deflationary pressures, China isn't yet in at-all-costs mode. Indeed, others, like Nomura's chief China economist Lu Ting, warned that the real challenge lies in the long-term efforts of these policies. While the current stimulus package provides immediate support, particularly for real estate and stocks, there are growing calls for additional fiscal measures, said Lu. Despite the years-long slump in the property market, the Politburo only for the first time emphasized the urgency to stop the decline and stabilize the real estate sector, reflecting the high level of concern over the sector's drag on the overall economy. The real estate sector's primary challenge is weak demand, with property prices still falling and no signs of recovery. Many companies are now focused on cutting debt to survive. On the supply side, developers face severe funding shortages due to declining sales. Despite support measures introduced in 2022 and early 2024, many are set to expire by the end of the year. However, market insiders argue that measures may not be enough to stimulate demand, as many potential buyers will hesitate to take on new debt given their pessimism about the broader economy. In addition, some developers complain that negotiating loan extensions with banks remains difficult, with banks hesitant to offer further debt relief, especially for highly leveraged companies, even with the policy extensions in place. The People's Bank of China's latest policy adjustments are set to challenge the banking sector, as declining interest rates squeeze profit margins and strain capital adequacy. Lower loan prime rates, LPR, and mortgage rates are tightening the interest spread, reducing banks' yields. In the first half of 2024, major banks including Industrial and Commercial Bank of China, China Construction Bank, Bank of China, and Agricultural Bank of China reported net interest margin drops of over 20 basis points compared to 2023. Experts argue that the recovery of banks' interest spreads hinges on the revival of financing demand in the real economy. Interest spreads are driven by macroeconomic, not just monetary policy, an economist familiar with monetary policy making told Caixin. Low inflation and sluggish growth are narrowing spreads, but a growing economy could reverse this trend, they added. Separately, former deputy head of the Development Research Center at the State Council, Liu Shijin, has advocated for a 10 trillion yuan stimulus package over the next 1 to 2 years, funded by ultra-long-term special bonds. His plan focuses on enhancing public services for migrant workers and low-income families, aiming to boost consumption and investment. Liu emphasized that the stimulus plan should differ from the 2008 infrastructure-heavy approach. Instead, he advocated investing in human capital, education, and healthcare to improve productivity and fuel long-term growth. But monetary policy alone will not be enough, said Xu Qiyuan, Deputy Director of the Institute of World Economics and Politics of Chinese Academy of Social Sciences, calling for fiscal stimulus to take the lead. He and other experts argue that while monetary tools still have the room to maneuver, fiscal intervention is key to driving economic recovery. Luo Zhiheng, chief economist at Yuekai Securities, recommended expanding fiscal policies by increasing government bond issuances to cover lost revenue from declining land sales, speeding up special bond issuance, and refining local government debt policies. Unlike monetary policies, expanding fiscal measures like issuance of government bonds and special bonds requires approval from the National People's Congress. So all eyes will be on the upcoming session of the MPC Standing Committee in late October, which may provide a crucial window for greenlighting any new fiscal initiatives. Here ends the direct quote and today's episode of China Update. Thank you so much everybody for watching. Have a great Tuesday, and I will see you all tomorrow.